So why is everyone talking about FuboTV stock? Well, one reason could be that the stock price is down more than 95% off its high, and a lot of investors are curious if this is an excellent buying opportunity. Another reason could be the company recently held a question and answer session with Wall Street investors that provided insights into what's going on with Fubo TV's long term and short term prospects. So, I'm going to answer the question of why is everyone talking about Fubo TV stock in this video by looking at that Q&A session and pulling out the key insights from the management guidance and prospects that it discussed in this conference call. So if you're interested in Fubo TV stock and if you're curious if this 95% drop in the stock price is a buying opportunity, you're not going to want to miss what's in this video. So stay tuned and let's get right into the details. So the first question is from Shweta from Evercore Institutional Equities asking about the early impacts you've seen from the price increase on churn. Okay, so let me back up a little bit and give you some background on this. If you're not aware, Fubo TV implemented a $5 per month price increase. And what this analyst wants to know is after you increased prices, how are you seeing customer behavior change as a result of higher prices? Are you seeing more cancellations? Are you seeing less signups? So this analyst is rightly curious about the changes in consumer demand as a result of the $5 per month price increase. So the CFO jumps in to say, so far they've got 2 to 3 weeks of data after the price increase went into effect. I would tell you we expected elevated churn. Churn is another word for cancellation. We expected more cancellations. But I would say that the cancellations that we're witnessing actually has come in below what we would have expected. Okay, so that's interesting. It's less than what you expected. What would have been more informative if management actually gave us some numbers. If they actually told us, well, as a result of that, we experienced typically in this part of the year we get 10% of customers canceling. This time around we had 15% canceling or 18% canceling. Whatever the actual numbers may have been, it would have been more informative if management would have told us that instead of saying it's better than what we expected. Well, what were you expecting? How am I supposed to know as an investor what you, the management, was expecting? You're not telling me what you were expecting. You're just telling me it's better than expected. And to me, I see that as management trying to frame this answer in a way to not reveal too much bad news about what's going on inside of the company. And I always ding and I always put an asterisk around management teams that try to do that because I'm skeptical of management trying to make things look better than it is in order to convince me to put my hard-earned dollars into the company as an investment. So uh, uh, I'm I'm not thrilled about the way management answered this question, although it is good news that they're saying it's better, the cancellations are better than expected. The next question from Shweta again as a follow up, asking about when was the first ever price increase? And how much was it and what was the impact of that one? So Shweta is trying to gauge the price elasticity of demand of Fubo TV customers. And let me elaborate what that means, price elasticity of demand. What that means, Shweta is trying to gauge how much pricing power Fubo TV has. If Fubo TV increases prices by $5, how many customers will they lose? Right? In all businesses, when you raise price, you lose customers. That's true for nearly all businesses. What Shweta is trying to find out is the magnitude of that difference, right? Some companies like Coca-Cola, they can raise prices and not experience that much of a decrease in customers, right? Because they're more of a consumer staple. It's part of consumer habits. Other companies that are more discretionary in nature, like Fubo TV, their price elasticity of demand, the magnitude is larger because consumers don't have to sign up to this service, or they have alternatives that they can sign up to that may cost less, that may be similar. And so Fubo TV's pricing power is not as strong as a company like Coca-Cola or Pepsi or maybe Kellogg's with their cereal. Companies that have really strong brand loyalty, consumer staples are high in that. So let's see how the CEO responds to this. So we did announce a price increase of $5. I think it was on April 2nd of last year. So speaking about 2022. And again, they're saying that they saw a little bit less churn than we would have expected in the second quarter as well. Again, I'm not thrilled that the company is answering in this format saying that they experienced less than expected, because it doesn't answer the question this analyst is trying to get at. What this analyst is trying to understand is, for every $5 increase in price, what is the quantity of subscribers that you are losing, the number, the figure, right? When management is saying that it was better than expected, it doesn't provide the insight that the analyst is looking for. It doesn't offer that insight as to what's that relationship between price increase and customer decrease. So management, and if I'm thinking like this, I know there's other analysts and investors that are thinking the same way, and I think that this analyst was not entirely thrilled either. Well, I shouldn't assume, but the fact that Shweta asked a follow-up, a similar follow-up to the first question, tells me that Shweta was unsatisfied with the first answer and tried to follow up in asking the same question in a different way, and got a similar response from management, just saying better than expected instead of getting any actual figures. That way, Shweta can model a financial relationship between price increases and customer decreases. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. The next question from Laura Martin is asking about YouTube TV, one of Fubo TV's main rivals. The Fubo TV is a little bit different than YouTube TV because it's sports centered. It's got more sports, but now YouTube TV just got the deal for Sunday Ticket. So Laura wants to know, how's that going to impact your business, right? Because you focus on sports enthusiastic customers. How are you going to keep them from going over to YouTube TV for the Sunday Ticket? So the CEO is saying, look, we're two companies that are now positioned to be sports first. The RSN TAM is significantly larger than Sunday Ticket. So RSN is regional sports networks. You think of the network that I'm in Los Angeles, the networks that give me the Los Angeles Dodgers, the Los Angeles Laker games, right? The market for that is larger than the Sunday Ticket. We're talking about 25 to 35 million sports fans in that category. So, and then YouTube TV is not exclusive. So it's not selling Sunday Ticket exclusively. So you could have YouTube Premium. You could sign up for Sunday Ticket through YouTube Premium, so you don't have to have the YouTube Live TV. So you don't. It's not necessary. So it's not necessary that Fubo customers need to switch to YouTube Live TV to buy Sunday Ticket. They can have Fubo and buy Sunday Ticket a la carte from YouTube separately. And finally, I will end with this question and answer here. William Lampin asking, you talked about 70 or so million of financing as of this morning. So, and then you have something like 400 million of cash on the balance sheet. Is this enough money to get you to sustainable cash flow, or are you going to need to raise more money? All right, let me provide context here too. So as of the date of this conference call, Fubo TV announced that it raised an additional 70 or so million dollars by selling its stock. Why does it need to keep selling its stock to raise equity? Because Fubo TV is losing a lot of money on the bottom line. Every quarter, every year, Fubo TV is losing money, both in terms of profitability and cash flow. So it needs to keep going back to investors and saying, give us more money, give us more money. give us more money. And then it proceeds to lose more money, to lose more money, to lose more money. And then it goes back to investors and says, give us more money, give us more money. And so you can start to understand why the stock price is down so much, why it's down 95% off its highs, right? Because the company just keeps losing money and then coming back to investors and saying, give us more, right? At some point, you got to get the business on a sustainable footing or show incredible progress towards that, which FuboTV is not doing. Now, I will say that they've made plans to be cash flow positive by 2025, although it remains to be seen if they will achieve that, and it remains to be seen for them to make meaningful progress towards that. So, understandably, this analyst wants to know, are you going to come back to investors again and ask for more money, or is this $70 million finally enough for you to get to a sustainable level where the business can operate itself and not need more money? So the CFO jumping in, I think we certainly outperformed the CTV marketplace, which grew around 30%. We grew around 30% when the market grew about 20%. Okay, so you're gaining market share. That's good news. And then saying that October was the best month for us, November was the second best, and December was the third. So it's going downward. Okay, the results are going downward. That's not good news. So I would note that for the fourth quarter, our cash usage was around 20 million. So for the fourth quarter, they burned through $20 million and then some, because now he's saying that's if you exclude some of the gaming costs. Okay, so they lost 20 million, and that's not even including the investments they've been making in rolling out the sports book that they now decided to pull back on. So that suggests we have enough money for the next 12 months. Okay, so that gets us into 2024, but we will be self-funding in 2025. So this further bridges that gap and narrows it pretty significantly. So if you could read between the lines here, it says the cash that they have on hand, that will get us to 2024. We're going to be self-funding in 2025. So they have enough money until 2024, but they're not going to be self-sustaining until 2025. What that means is they're going to need to come back to investors and borrow more money or sell more equity to raise more money. So the answer to the question in a long-winded way was no, we don't have enough money to get to self-sustaining. We're going to need to come back to investors and raise more capital, which is never a good thing for a stock, right? Either if it needs to raise more, borrow more money, that's bad news because it's going to increase the interest expense, and the debt is always risky. If it needs to raise cash through selling stock, that's going to dilute shareholders, and you're going to have to share your ownership with a greater number of shares outstanding, which is also not good news. So either way, not good news, and you can start to understand why investors and shareholders have not been happy with FuboTV and FuboTV stock. That's understandable because the company has proceeded to lose millions and millions and millions and millions of dollars. But thankfully, it's actually focusing on reaching a self-funding level in 2025. So I will be monitoring their progress towards that goal every quarter, and every update they make, I will be closely monitoring that progress. All right, so I hope this video has shed some light as to why everyone is talking about FuboTV stock. As always, I appreciate your viewership, and I have hand selected a few videos that are popping up on your screen right now that I think you will enjoy. So please click on one of those, and I'll see you over there.